Good afternoon, everyone. Welcome to our panel. Our topic is the dark side of payments, understanding the illegal uses of crypto and Bitcoin, dark web payments, fraud, money laundering, and other illegal transactions. My name is Jeff Roode, and I will be the moderator of the panel. I'm a lawyer in Toronto practicing on my own. I practice in the fintech and payments industries, doing a lot of commercial transactions and regulatory issues. I think our panel is a bit unusual in the 2021 Payments Summit because I think most of these sessions will be focused on all the good things and innovation happening in payments. And we're going to do something different and talk about some of the bad stuff that's going on in payments. And our panel is also a little bit different because we have all lawyers. So this will be kind of legal focused. But we're lucky to have four real experts in payments with us today. We're also going to cover 3 jurisdictions in only 55 minutes. So we got 2 Canadian lawyers, 1 UK lawyer, and 1 American lawyer. And given that that's a lot of ground to cover, I think we probably will not have time for audience questions, although you can certainly post them if you want, and we may be able to get to a couple of them at the end. So without further ado, I'm going to introduce our panelists. So the first person I would like to introduce is Anna Badour. Anna co-leads McCarthy Tétrault's National FinTech Group in Toronto. She's a partner in the Financial Services Group and a certified anti-money laundering specialist. She advises financial services entities, including financial institutions and fintech entities, on regulatory and compliance matters, including with respect to consumer protection, anti-money laundering, and other regulatory requirements. And so not surprisingly, Anna's going to talk to us about money laundering and terrorist financing, including a brief overview of the relevant Canadian legislation, the regulators, recent AML amendments and consultations, as well as some of the technologies and trends in the industry. Next, I would like to introduce Usman Sheikh. Usman is a partner in Gowling WLG's Toronto office, where he's the national head of the firm's blockchain and smart contracts group, as well as the national litigation lead of the firm's securities, compliance, and investigations group. Usman's practice focuses on providing legal advice on blockchain advisory mandates, including token sales, crypto asset trading platforms, and others. And he also specializes in securities litigation and crypto litigation. Next, Usman will talk to us about crypto and blockchain issues, illegal and illegal uses, as well as sort of regulatory issues and other trends in that area. Next, I'd like to introduce Andrew Bigart. Andrew is a partner in Venable LP's Washington, D.C. office. His practice focuses on helping bank and non-bank financial institutions navigate the federal and state regulatory environment governing payments, lending, and consumer financial services. Andrew provides regulatory and business counseling advice to clients across a variety of industries, including banks, payment companies, money transmitters, broker-dealers, lenders, and trade associations. And so Andrew obviously has a U.S. focus, and he's going to talk to us a bit about anti-money laundering and related legal frameworks, as well as some of the U.S. focus on fraud and risk these days. And finally, let me introduce Gavin Punia. Gavin is a partner at the London office of Bird & Bird LLP, with a particular focus on advising firms who are digitally transforming the way financial services are being delivered. And he offers particular experience in the regulation of payment services and electronic money products. Gavin's practice area also includes assisting firms with compliance programs for non-sector specific regimes such as AML, bribery and corruption, and market abuse. And so Gavin actually will talk about UK issues, including crypto exchanges, their licensing, AML requirements, some UK government consulting on these issues, and cybercrime and crypto in the UK. So that is the intro. Anna, I think you're first, so it's over to you.
Great, great to be here. Thank you, Jeff, for the introduction. And I'll start off with a very quick kind of high-level overview of anti-money laundering regulation in Canada before we dive into the other topics. And so maybe to start with terminology, and I know these concepts are well known probably to most, if not all of the audience, but just to level set, money laundering refers to the act of disguising the source of proceeds and funds, and where those funds or proceeds really originate from criminal activity. And it involves 3 stages, the first one being placement, the second integration, the second layering, and the third integration. So placement is essentially taking those proceeds and placing them in the financial system. Layering is the process of converting them. And integration is essentially placing those converting funds back into the economy. It's always difficult to estimate the actual amount of money laundering occurring at any one time, obviously due to the fact that it's linked to criminal activity. So estimates do vary, but some estimates, for example, from the United Nations recently estimated it at approximately USD 2 trillion per year globally. So certainly a large amount of activity tied to money laundering globally at any one time. The kind of parallel concept is terrorist financing, and so you often hear a reference to AML CTF, that's anti-money laundering, counter-terrorist financing. And terrorist financing is concerned not so much with the source of the proceeds as much as with the use of the proceeds. And in some cases, the source may also be from illegitimate sources, but in some cases they may be properly legitimate funds, such as from charity, etc., but they're being used in a way that is criminal. So terrorist financing much more focused on how the funds are being used and really tied to the funding of terrorism. In terms of the regulatory scheme in Canada, the primary legislation is the Proceeds of Crime, Money Laundering, Terrorist Financing Act, PCML-TFA, for those of us who have to refer to it quite a bit, its regulations as well, and guidance from the regulator, which is FINTRAC. FINTRAC being Financial Transactions and Reports Analysis Centre of Canada. It's the financial intelligence unit and also the regulator, and it issues guidance from time to time as well. And so really has a enforcement and supervision role with respect to the prevention, detection, and prevention of money laundering and terrorist financing. The PCML-TFA only applies to certain types of entities and not all types of entities. So it is limited in scope in that way. That being said, there is also the criminal code, and the criminal code applies to everybody. And it has provisions dealing both with proceeds of crime as well as with terrorist financing. So always important to remember that even if an entity is not subject to the PCML-TFA, there are still some relevant pieces of legislation to look at in this area. That's the Canadian scheme. Now, globally, there's an agency called the Financial Action Task Force, FATF or FATF, depending on how you like to pronounce it. It's the global standard setter for AML CTF, and there are a number of member countries, over 200 member countries, including Canada. And those countries that are member countries essentially take those recommendations and implement them into their domestic legislation. So FATF has issued a set of 40 recommendations and also issues guidance from time to time, and some of that guidance, for example, is very relevant to this context, dealing with virtual assets and how those fold into the regulation of money laundering going forward. FATF also conducts country evaluations, and the last one it did for Canada was in 2016. And in 2016, it identified a number of areas where, in effect, Canada could be doing better. And so it identified in particular prepaid cards and cryptocurrencies and money services businesses as some of those areas, and new technologies more generally. And essentially pointed to the fact that there could be further regulation in these areas in order to close some of the gaps. And so not surprisingly, we've seen some recent amendments essentially implementing and trying to close in on some of those gaps. And those amendments have been to the regulations, to the PCML-TFA, and have come into effect in a bit of a staggered manner. And the key ones really were June 1 last year and June 1 this year. As of June 1 last year, dealers in virtual currency were required to register with FINTRAC as money services businesses. And as of June 1 this year, i.e. yesterday, prepaid cards, those regulations are now in force, as well as there are now reporting obligations and record-keeping obligations with respect to virtual currency transactions. And finally, the travel rule now also applies to virtual currency transactions. One item as well that I think really needs to be mentioned when you're talking about AML regulation in Canada and where things are is the Gowling Commission. And the Gowling Commission is a commission that is currently in the news from time to time. It's occurring in British Columbia, And it's a very wide-ranging investigation into money laundering trends that are occurring in the BC market. And it originated from a set of reports that were commissioned by the Attorney General of BC, initially focused on the gaming sector, following some news stories about money laundering activity in the gaming sector in BC, but then broadening to other industries as well. And so that commission has really been kind of a big review of money laundering activity in the BC market in particular. Currently still in the process of conducting hearings. A preliminary interim report was issued last year with a final report expected by the end of this year, and will definitely have quite a bit of information in terms of money laundering risks that have been identified and recommendations that may impact on the legislation going forward. Now, it's important to remember it's a provincial investigation and commission. It is not federal, and the legislation I've mentioned is all federal. So there is a bit of a constitutional tension there, but definitely something that will have an impact in terms of how we look at money laundering risks and regulation going forward in Canada. So maybe I'll pause there. Jeff, I know that we are tight on time, so I just want to make sure that to give time to others.
Yeah, I think that's right. You'd mentioned the travel. I'm not sure I know what the travel rule is. What is the travel rule?
For sure. So the travel rule is a rule that exists right now for other types of entities such as banks, and is really something that is required globally by the FATF, and in fact originated originally from the US. And it requires entities, when they're sending funds, to include certain information along with the sending of those funds, so that colloquially, that the source and other type of information is following and traveling along with the funds. And the challenge that really occurs with respect to virtual currency transactions in particular is that, particularly when you're looking at the Bitcoin blockchain, et cetera, it was never built to carry that type of information along with the transaction. In fact, it was probably purpose-built for the opposite, to make transactions, et cetera. So in requiring entities to start to collect and transmit that kind of information, you're essentially requiring something that technologically was not built into the infrastructure, right, or quite challenging. So that's where the tension lies with that.
Good. And so we've had some changes recently. Is there any future changes you're expecting to the AML regime in Canada? Well,
I think the AML regime in Canada is always evolving, and certainly I would think that recommendations coming out of the Gowling Commission are something to watch for. And more broadly, gaming is being legalized to some extent in Canada, online gaming, and we would expect to see some changes tied into that. There have been other items, referenced in the budget recently, really focused on additional enforcement, particularly in the MSB sector. And because we have a new regime, the Retail Payments Act, Payment Activities Act, that will be dealing with payments in particular, that really drives some of the focus on MSBs going forward as well. So I think there's a slew of things that could evolve. I think broadening of the scope of the types of entities that the legislation captures is something that is always under discussion. But I think maybe, as we turn to the discussions on crypto assets in particular, I think some of the tensions and developments in the future may be really focused on that as the legislation catches up to the technology.
Yeah, that makes sense. Well, thank you, Anna. That's a good segue, I guess, for Usman.
Yeah, that was terrific. Thanks, Anna. Thanks for having us, Jeff, as well. And apologies for the mugshot-looking background. I thought it was appropriate for the topic. So I was asked to cover off the blockchain and crypto asset component to this topic in about 11 to 12 minutes, which is a bit ambitious, but let's get started. And I thought I'd begin, if I may, with a little bit of a blockchain 101 background. For those of you who are in the audience who are unfamiliar with the technology, blockchain technology, simply put, is really at its core nothing more, nothing less than, again, at its core, a ledger. In fact, another name by which blockchain technology will go by is DLT, or distributed ledger technology, although the two terms are not exactly synonymous. Now, many of you in the audience may be scratching your head wondering, what's all the fuss about? Why is there so much media hype and interest over all things being a ledger? You really have to consider how important a ledger is in your life. So take just a simple banking transaction, and let's say Anna wanted to send $50 to Jeff. She would go to her bank, they would check her debits and credits, her ledger, and they would then send a message to the correspondent bank that then sends a message to Jeff's bank, and everybody updates their respective ledgers, reflecting the fact that Anna is $50 poorer and Jeff is $50 richer. That same form of transaction using ledgers is really at the core of so many of our critical everyday transactions, whether you think of a stock transaction, a real estate transaction, many, many others. Now, the common denominator within all of those very traditional types of transactions, that was sort of like the silent common denominator in every single one of them, was the need for a trusted third-party intermediary. So in that bank transaction that I was talking about, it was really Anna's bank and it's Jeff's bank. And we trust Anna's bank to tell us that she has $50 or that she does not have $50 versus trusting Anna herself, although knowing Anna, she's an offensively trustworthy individual, but that's who we trust. Her bank and the bank maintaining the ledger is really the single source of truth for what Anna has or doesn't have. And in fact, digitally, it's essential that there be a trusted third party behind those transactions because of what we call the problem of double spend. The fact that Jeff, let's say, and I hate to pick on my colleagues on the panel here, could take $5 represented digitally and simply just copy it multiple times and then send $5 to Andrew, send $5 to myself, double and triple spending. And that's why we have many trusted and a whole industry of trusted third parties to stand behind those transactions to make sure that he isn't doing that. So really then, what is the uniqueness of a blockchain ledger? It's unique because it's a ledger that is maintained and allows for transactions to occur without having to go through any one of those previous trusted third parties that I'd mentioned. And in fact, there's no reliance, in fact, on any trusted third party specifically within these protocols. So take Bitcoin, it's a ledger of who owns how much and what quantum of Bitcoin, which is a native crypto asset for the Bitcoin protocol. The ledger, in fact, is not held by one single party who is a single source of truth and who updates it, and we trust that party. That ledger is in fact held by many, many parties around the world. It could be you, it could be me. I can turn your computer that you're looking at right now into a holder of that ledger. And although these parties who all hold the ledger are anonymous to one another and could be any one of us, the way that these transactions are updated is through a method that they agree upon, what we call in the industry as a consensus validation mechanism, where I'll spare you the technical details, but one is not putting one's trust in a trusted third-party intermediary. What one is putting one's trust in is mathematics and cryptographic proof. And so there's many benefits to this technology, one of which is probably the most obvious, which is that we're able to disintermediate with this technology, which is what many have seen as the brilliance of the technology. Some say the revolutionary or evolutionary aspect of it, which is the ability to remove these traditional third-party intermediaries from our normal everyday transactions, all of whom are, rightfully or wrongfully, taking a fee for their service. So think of credit card providers, stock exchanges, many, many other intermediaries that stand between us in order to affect transactions. So blockchain technology is able to theoretically, and has been, disintermediating those parties. Because you're able to remove those parties, these transactions are also far less costly, they're less complex, some say more secure. So you can easily see why so many and so much interest has been with this technology in the payment space. And in fact, really disrupting the payments world was a very reason for the creation of Bitcoin. If you go back to the original white paper for Satoshi Nakamoto, this anonymous sort of mysterious individual, group of individuals, he, she, they, we have no idea who is really Satoshi Nakamoto. When you look at the original white paper, the very first line in the abstract section at the very top, the very first line of this very paper is to set out the mission, which is, quote, to create a purely peer-to-peer version of electronic cash that would allow online payments to be sent directly from one party to another without going through a financial institution, end quote. Now, many retailers are using these crypto assets to allow transactions. Think of Microsoft, Remax, Burger King, even some law firms are doing so. And it allows for these transactions to be done far more quickly. So you can see how this transaction or this technology is being used in the payments world, disrupt international remittances. We're seeing a lot of things called CBDCs or central bank digital currencies relying on this technology, where you can achieve that efficiency, that speed, that reduction of cost, and also at the same time, effectively almost create programmable money. So with that, let's talk a little bit about what today's session is about, which is the dark side of payments. Like many other innovations, particularly emerging tech, think of the internet, the earliest uses of blockchain crypto assets were in the criminal space. You can see, based on the way I've described the technology, why it may have been the case that criminals would be seizing on crypto assets and blockchain. And it's for some of the reasons that Anna had mentioned. So one of them is that you're able to achieve almost instantaneous cross-border transactions on a global scale very quickly from one jurisdiction to the other, and the transaction will be cleared within 10 minutes, regardless of whether somebody is sitting next to me and I want to send them the transaction, or whether they're in, let's say, Washington, D.C., like Andrew. There's also a decentralized blockchain network, meaning that you don't really have these regulated banks or third parties that are involved or necessarily involved in clearing these transactions, which also makes them attractive to criminal parties. And then you also have the pseudo-anonymity of the ledger. In other words, we can see all the transactions on the ledger, but we don't know who's behind them. So it's unsurprising, therefore, that some of the earliest, most popular cases involving blockchain were in the criminal space. So think of cases like the prosecution against Silk Road and its founder, one of the largest dark net markets, where you can buy narcotics, you can buy fake IDs, you can buy murder for hire, estimated to be more than 100,000 users who are buying more than $200 million worth of contraband. The payments in that case were in Bitcoin. Think of also the recent DOJ prosecutions against John Woo's son, which was the largest takedown of one of the world's largest darknet child pornography websites, where users paid for content exclusively in Bitcoin. Think of the Mueller case, the Department of Justice of the United States' case against Viktor Netchenko, who was using Bitcoin to support Russian intelligence agents' efforts to meddle in the 2016 presidential election and hacks on the DNC server. And just last month, Colonial Pipeline was hit with a pretty hefty ransomware attack where the ransom that they had to pay was in Bitcoin. So just two really quick important things to note is that public blockchains may not, actually be the best way to effect a crime, because all of these transactions can be traced on a public protocol and on a website. And another important point to note is that according to Chainalysis, a forensic auditor of the chain, and specifically their 2021 crypto crime report, they reported that crypto-related crime fell significantly in 2020. Specifically, only 0.34% of all crypto transaction volume could be affiliated with illicit activity. I suppose just the last thing to note is that, as Anna had mentioned, there's been a lot of regulatory action in this space to try to deal with the perceived and actual threat of the dark side of crypto. And that includes legislative amendments. So Canada was one of the first jurisdictions to implement blockchain-specific legislation, and that was an amendment to the proceeds of crime legislation that Anna was talking about. The amendments didn't really kick in until regulations were adopted, and as Anna had mentioned, they only came into effect in June of last year, June of this year. And now those who are in the business of dealing in virtual currencies do have to register as MSBs, or money service businesses. They do have to adhere to the travel rule, as Anna had mentioned, and adhere to record-keeping obligations, reporting obligations for suspicious transactions, and put in place compliance programs, et cetera, et cetera. So I thought I'd maybe stop there, Jeff, and
yeah, that's great, Usman. I guess there needs to be some sort of balance struck, though, because obviously there's a lot of good uses for crypto, blockchain, and some bad uses. So how do the regulators strike the right balance, or are they doing that?
Yeah, it's a really tough thing because, some say that Satoshi Nakamoto actually kept his, her, or their identity confidential because they would be, in a very early stage, a single source of failure for the entire protocol. And so let's say Silk Road was occurring, the FBI were to bring in Satoshi Nakamoto, and then you see the downfall of the entire protocol. And
Right.
this very innovative thing falls with it. And so what we've told regulators, in order to balance that tension between encouraging innovation on the one hand, but ensuring protection, is one thing is case selection. So to go after the clear frauds, so as to not go against parties who are maybe operating in the gray zone, who just need some guidance.
Right.
And the other thing is to put out guidance, because many parties, rightfully or wrongfully, didn't in fact know that laws like securities laws or AML laws may apply to their operations because the project was just so new and novel. So those are a few things that we've recommended.
Okay, great. Thanks very much. That makes a lot of sense. Andrew, can turn it over to you.
Great. Thank you, Jeffrey, and thank you to the Summit for having me here. I think this is my second year being able to join on this panel. I do have a playlist that I would like to get up, so if you give me just one moment, I can get that going. Can you see that?
Yeah, we can see.
Okay, great. So I'm going to give some background on AML and anti-fraud efforts in the U.S. And I have a presentation because for many in the audience, the U.S. legal framework may be a little bit different or new, and I thought it might be helpful. But I think, as we've heard from Anna and Usman earlier, there's definitely overlap in between what's happening in Canada and some of the issues that are being focused on, and what is happening here in the U.S. as well. So with that, let's start with the U.S. legal framework for anti-money laundering. And here in the U.S., the main law governing AML is the Bank Secrecy Act, which requires certain types of financial institutions to implement anti-money laundering programs. The types of entities that are subject to this are what you would expect for the most part: banks, credit unions, securities brokers, money transmitters, casinos, and the like. So it's pretty broad. And what is required of financial institutions is to establish AML programs that they operate, which consist of policies and controls for monitoring and reporting on suspicious activities, for performing due diligence on customers, and similar activities like that. In particular, one of the key requirements is to monitor for suspicious activity, the types of dark payments that we've been hearing about, and to file reports with the U.S. government on those activities when identified. Similar in the U.S., we have pretty strong economic sanctions programs, which are administered by the Office of Foreign Assets Control, part of the U.S. Department of the Treasury, which helps the U.S. maintain different sanction programs on countries, individuals, and entities that all U.S. persons are required to comply with. So together, the BSA, AML laws, and OFAC really set the stage for what financial institutions are required to do in terms of AML. In terms of payments, payment processors, different types of payment facilitators are not necessarily financial institutions that are subject to AML requirements directly here in the United States. It depends a lot on the specific types of activities that they're engaged in. and also what maybe their contractual requirements are based on the relationships that they have with banks, et cetera. But in the US, the concept of money transmission is a regulated activity at the federal and state level, where a money transmitter is really defined as any entity or person that receives payment or funds from one person for purposes of transmitting to another, which is really what most payments companies do, right? They help facilitate the movement of payments from point A to point B. If you are engaged in those type of activities here in the US as a money transmitter, you have to register at the federal level with the Financial Crimes Enforcement Network, the main AML regulator, and comply with kind of the different AML programs I was mentioning earlier. At the federal level, however, there is an exemption for payment processors, which is really an entity that's receiving payments almost as an agent for a merchant or a payee. And under those circumstances, you don't have to register at the federal level, which is why I said earlier that some payments companies are not directly subject to the federal AML requirements. However, being a federal-based country, there are numerous states, almost every state, in fact, has a law on money transmission that also has licensing and other requirements. And while there are similar exemptions for an agent or the payee at the state level, they don't apply everywhere. And so it's very difficult to launch a nationwide payments program that doesn't involve money transmission unless you outsource that function to another financial institution. There's been a lot of reform in the US over the last year or so in the AML world. Part of it has been focusing on new beneficial ownership requirements and finally the creation of a nationwide registry to track beneficial ownership information. That's a new law that just came out, and that registry will be implemented over the next few years. There's also been an expansion of the definition of financial institution that is subject to AML requirements to finally include virtual currencies. Now, FinCEN has issued guidance in the past explaining how cryptocurrency exchange would be a money services business, a type of money transmitter, but this actually is putting that more directly into law. And I think it's an example of how the US is slowly taking steps to bring cryptocurrency more within the regulatory fold, and we can probably talk about a little bit more of that later. In terms of other AML developments, FinCEN is putting out a lot of potential rulemakings on establishing AML requirements for cryptocurrency, asking for information on the best practices that financial institutions are using to manage BSA AML. There's really a lot of focus on this right now here in the US. And I think when you talk about what are US law enforcement focus on when it comes to the dark side of payments, well, you can break it broadly down into two different types of fraud. You have the fraud that occurs from the theft of funds, maybe identity theft, or other similar activities, which is a significant concern. But here in the US, we also have a very significant focus on fraud that happens from the illegal or deceptive or fraudulent sales of products to consumers. And US law enforcement agencies, the Department of Justice and the Federal Trade Commission and others, will frequently bring enforcement actions against payments companies that are facilitating the unlawful sale of products by merchants. Basically saying that as a payments company or the bank that's facilitating those payments, you have an obligation to perform diligence and make sure that the merchants that you're serving are not engaging in unlawful activities. And there's active enforcement here in the US against banks and different payments companies for failing to comply with AML. I have a few of those up here on the screen. But just jumping more to payments, where we've seen a lot of, maybe skip forward for a second. We've seen a lot of focus on payments is from the Federal Trade Commission, the Department of Justice, and even the Consumer Financial Protection Bureau, bringing enforcement actions against payments companies for facilitating these unlawful sales, like I mentioned. And I think what's interesting is that these US agencies will take a very broad view of US jurisdiction. Even if you're a payments company located overseas, if you're facilitating the sales by foreign merchants of deceptive products to U.S. consumers, U.S. law enforcement will bring enforcement actions in those circumstances. And so there have been cases against processors located in Eastern Europe and other parts of the world for facilitating these types of unlawful activities. And to go back for just a second to the other type of fraud that's out there, there's certainly a large focus in the US on cybercrime and identity-based type fraud. Usman mentioned earlier the ransomware attack that just happened here in the US against a pipeline company that shut down oil kind of production here on the East Coast of the United States for several days. There's currently a large US meat company is subject to a ransomware attack as well. This is becoming an increasing problem. Synthetic identity fraud, essentially creating fake customers using a combination of real and fake personal identity information to allow for opening up of accounts is something we're seeing a lot more of. And even just basic business email compromise, where people are tricked at companies into sending their bank account information to fraudsters through phishing emails or wiring funds to the wrong bank account is really a big problem that we're seeing a ton of. So I guess that probably brings me about to the end, Jeff, of the U.S. overview here. Obviously, what can be done to fight fraud? Compliance is a huge issue here in the U.S. Something that the examiners and regulators look at to make sure that you've got a robust AML program in place and that you're doing it properly. I think moving forward, there's going to be an increasing focus on technology around authentication to make sure that if you're a financial institution, you actually are able to verify to the greatest extent that you can that the individuals or the businesses that you're dealing with are who you think they are. And just general, continued pressure on due diligence and kind of know your customer or know your business customer is going to be something that's emphasized as well.
It's great, Andrew. Thank you. Is anything? Are you expecting big changes now that you have a new president in the office in regulation of the payments industry?
Yeah, I think that we will see some changes, but I think it will also be kind of a continuation of some of the themes that I've already touched on. The Federal Trade Commission, the Department of Justice, some of the other law enforcement regulators have been active in going after payments companies. And I think you can see that to continue, if not even speed up maybe under a Biden administration. In particular, the Consumer Financial Protection Bureau is probably going to be reinvigorated under a Democratic administration. They've already brought one case against a payment processor that was facilitating fraudulent sales through remotely created checks. And I think you can see the CFPB being more involved there. I think that, I think Usman mentioned, central bank digital currencies. That's something that has been looked at by the Federal Reserve here in the US and continues to be explored as in terms of figuring out what would the benefits potentially be, what would some of the drawbacks be, and how could it be set up. I don't think that is anything that will happen anytime soon here in the U.S., but continues to be a lot of interest in that and guidance and discussions that are put out by the federal government there.
Great. Thank you, Andrew. Gavin, over to you.
Thanks, Jeff, and thanks for having me on this panel. So from a UK perspective, there isn't currently an existing authorization or licensing regime for crypto assets, whether that's through issuing crypto assets or facilitating the transfer of crypto assets. And that's really come from the reluctance of the government and regulators to legitimize crypto assets in a way that is similar to other types of existing financial instruments. However, as we've seen over the last few years, there's two key issues that have come to the fore: the increasing risk of financial crime through money laundering, and also the increasing threat to individuals or consumers not understanding the risks in buying or holding crypto assets. There's also another area of kind of consumer protection, particularly in the UK, where there's increasing marketing of cryptocurrencies through social media channels such as YouTube, Instagram, and other public social media channels. And that's meant that individuals who aren't necessarily up to date and clued into crypto assets are buying into the market at completely the wrong time. That's also linked to the existing lack of transparency with exchanges that has allowed market abuse to happen with pump and dump schemes, and in some instances, exchanges holding positions in relation to crypto assets. So firstly, in relation to the increasing risk of financial crime and money laundering, the UK implemented money laundering requirements emanating from EU legislation in January of 2020, which meant that exchanges, issuers, and wallet providers of crypto assets are subject to the UK money laundering requirements. So they need to be registered with the UK Financial Conduct Authority and have ongoing requirements around applying customer due diligence to either users or customers or counterparties, depending on the services that they provide. And I think one thing to note there is, as might have been the case before, that registration process was a relatively straightforward, short form registration. And the kind of material requirements were kind of ongoing compliance relating to money laundering. But the FCA has actually put in a very rigorous registration process, which is akin to being licensed, which requires firms to provide upfront compliance manuals, AML policies and procedures, details of how they would report suspicious transactions. So again, they're trying to increase the level of compliance at an early stage with providers in the crypto asset space. On the marketing and consumer protection side of things, the UK government is also currently consulting on changes to the existing authorization regime, particularly in relation to stablecoins. So again, issuers, exchanges, and wallet service providers of stablecoins will need to be authorized if this proposal becomes law. And also those that are entering or providing stablecoins as a means of payment, or facilitating stablecoins as a means of payment, will also need to be authorized. Along with that proposal is a government consultation on extending the financial promotion regime that is currently in place to crypto assets. So that will, in the UK government size, try to address the risk currently of people in the way that they market crypto assets on YouTube and Instagram. At the moment, obviously with payments, there isn't a massive use case in relation to how the FCA regulates that in relation to crypto assets. But as stablecoins are becoming more popular, the UK government is looking to regulate stablecoins and see that as the kind of, or push that as the way that crypto assets might become a form of payment. The other point is that there's obviously, as discussed on this panel, a huge increase in cybercrime and crypto, and that's been mirrored in the UK. I know that Usman mentioned that there may have been a decrease in the overall activity of crypto asset crime, but I think it's notable that with ransomware attacks, that has significantly increased. I think Chain Analysis recently reported that ransomware attacks were up 311% in 2020 when compared to 2019, and that seems to be an increasing way of bad actors using crypto assets. There's also been an increase in wallets being hacked. That's always been an ongoing risk, and one of the reasons why the FCA in the UK was reluctant to regulate crypto assets. But I don't think there's been an easy answer in the way of ensuring greater security around the way that people hold their crypto assets. Jeff, I'll just hand back over to you in case you've got any questions.
What is the EU doing in terms of regulating crypto assets as opposed to UK?
Yeah, so they've also recognised that there needs to be a gap that needs to be filled. So the European Commission, which is responsible for proposing legislation, introduced a proposal last year called MiCA, which stands for Markets in Crypto Assets Regulation. And what that is trying to address, similar to the UK, is to regulate issuers, exchanges, and service providers, but goes a lot wider to cover not only stable coins, but also other types of crypto assets with an authorization and licensing regime. And even in relation to crypto assets, which are not necessarily stable coins or e-money tokens, those will still require a white paper to be published, which meets the requirements of the standards set out in MiCA or subsequent what are called regulatory technical standards. I think what's noticeable with both the EU proposal and the UK, which I forgot to mention, is that there is a high likelihood that it will capture providers outside the EU and the UK respectively. So if you are looking to issue or provide services into the EU and the UK just because you're located outside of those jurisdictions, that doesn't mean necessarily that you're not going to be caught by these regulations. If you're looking to market or provide these services to consumers or companies in the UK or EU, you're likely to be caught by those respective regimes. Obviously, there's going to be a case by case analysis, but you shouldn't necessarily assume that just because you're located outside of the EU, UK, you won't be caught by these regimes. So it's worth keeping an eye on how these proposals progress in the next year or so.
What about Brexit, Gavin? Because it sounds like some of the UK laws were based on European standards, and now you're out. So are the laws going to change, or what's the thinking there?
Yeah, so with the UK, with EU financial services legislation, it was kind of just basically implemented over. And so it will be for the UK government to make changes as and when, or the regulator to make changes, which they have done in particular areas. But with money laundering, a lot of that was implemented before Brexit. So the fifth money laundering directive was EU legislation, which extended the money laundering regime to capture crypto assets in the way that I've described. And the UK has kind of kept that going. Obviously, now we're in the post-Brexit world since January of this year. The UK is now, or the UK government has proposed a regime which is slightly different to MiCA, which I described for the EU. So as we are, probably it's very similar, but as we go forward in the next couple of years, there will be slight divergences in the way that the UK regulates crypto assets versus the rest of the EU, or what is now the EU.
Right, and is the EU planning to do a regulatory framework for wallet service providers and people like that?
Yeah, so that will also be captured within MiCA as well.
I see, okay. Well, thanks to our panel. We actually have a little bit of time, and we did get a couple of questions in from the audience, one of which I think might be right for Anna and Andrew together. It's someone wanting the panel's views on the effectiveness of AML laws. The question is, I understand globally less than 1% of fraudulent funds are intercepted, and the costs are colossal. Do you guys have any views on that, how effective the laws are in this area?
Yeah, so I mean, it's a bit of a fraught topic. There's certainly, it is a bit of a blunt tool in many ways, and it offloads a lot of the responsibilities and costs on the reporting entities to essentially monitor what, at the end of the day, is criminal activity. It's what we have right now. There's very little by way of evidence available as to how well it does work. So you know, there's certainly some criticism that's valid there, I think, in terms of the fact there's quite a bit of cost compared to perhaps the effectiveness. It's definitely a balance that regulators struggle with and try to improve on and be mindful of. But you know, that's kind of the basis of how a lot of that was formulated, which maybe I'll turn it to Andrew, because I think, you know, the US really led the charge on that and has inspired the rest of the world to follow course. So you can speak to what the...
Sure. Yeah, I think that's one of the challenges and complaints that frequently are raised. At least in the US, if you look at banks, for example, they have massive amounts of resources that are committed to their AML programs and you know, monitoring alerts that are generated by their software monitoring systems and clearing them and doing the reporting. And I think there are, you know, criticisms that get raised that this isn't the most efficient use of resources, or that it's just a significant burden financially and resource-wise on the financial institution. You know, I think that if you talk to the US regulators, they put out reports pretty regularly about enforcement actions that are brought and how they leverage information provided and reported by financial institutions. So I do think that it plays, you know, an important role. I think, you know, how does that balance maybe get done a little bit better? I think the hope tends to be that technology will continue to get better and better in terms of some of the machine learning or AI type systems that are out there that maybe can do a better job than current kind of rules-based systems in terms of trying to identify fraud and suspicious transactions, and thereby, you know, FIs will be able to kind of allocate their resources better. But I think it's going to continue to be a challenge. I mean, fraudsters find ways to stay in the shadows, and oftentimes are not necessarily going to be caught. It's just kind of the nature of it. But I think it is important to continue to try to fight it and do the best that, you know, the financial institutions can do.
Okay, thanks, Andrew. I think we have time for one quick last question, which really seems up Usman's alley. Why are criminals still using Bitcoin and not Monero, Zcash, or Ironfish? Do you have any insight into that? We can't. You're on mute there, Usman.
I said something totally hilarious, and I just said it to myself. So I said, ask them. I don't know. I don't want people to be left with the impression that using Zcash and other digital assets that happen to be labeled one way or the other as privacy coins is the equivalent of being nefarious conduct. And there's a whole great debate on this, and there's active discussion with FinCEN, and I've seen those discussions with others. But think of those who use those types of digital assets as having a philosophy that why should there be a trail with my crypto assets or my financial transactions? Why can't I achieve something that is tantamount to cash? Why do you need to see an audit trail of every single transaction that I have? So I don't want people to be left with the impression that somehow a privacy coin is somehow nefarious. There's actually an active debate about whether they are any different than cash, and why should there be extra fettering, if you will, added to those digital assets than others. But
right. Okay. Well, I think that is about all the time we have. I want to thank each of you for participating. It was certainly very interesting to hear the different jurisdictions and our different view on things. I think the challenge, for any regulator in the payments field is, of course, to, as Usman and I talked about, balance, you know, let the innovation happen, let all the good stuff happen, but try to keep the bad guys' activities to a minimum. I don't think that's an easy challenge to solve, and I don't think we're finished talking about this. And I'm sure future payment summits, we can keep doing this panel, and there'll be lots of new stuff to talk about. So anyway, thank you all very much for participating.
no problem. Thanks for having us.